Hi, this is Steve and Susie Neal with the Neal Estate Group, Berkshire Hathaway Beach Properties of Florida, down here on beautiful 30A. Now, I would imagine there are a number of you out there that would love to be buying a beach home right now, but you've been holding back due to a variety of economic concerns. Susie and I wanted to discuss some of these and perhaps offer some suggestions for ways you may offset some of these worries.
So the first reason that you might be concerned is the worry over rising mortgage rates. We know that many of you all out there would love to buy a beach home, but would have to finance it. So you're having major sticker shock when you see the impact of these rising mortgage rates. Now, as we all know, interest rates have had a dramatic rise since the beginning of the year, and will probably continue to rise in the near term, albeit at a slower rate. Now, this increase is going to continue until inflation shows definitive signs of easing. And at that point, the Fed is going to halt their rate increases.
So another thing that may be holding you back is the prospect of the economy going into a recession and what that might do to home prices. Well, experts for 2023 on a national level expect home prices to actually show modest appreciation, up maybe about 1.8%. And that would actually be in line with what we've seen during 4 out of the last 6 recessions, where home prices actually increased. So the exceptions were 1991, where we had a modest 1.9% decrease, and in 2008, which was the debacle we had then, where home prices pulled back substantially, but that was by and large due to the very lax lending standards, and those have been strengthened substantially. So I think a repeat of that is highly unlikely.
Now, another reason why buyers are hesitant right now is based on the assumption that you're going to see a substantial drop in home prices. Now, remember that although inventory has increased, home supply is still historically low and demand is still extremely high, especially in our area. So rather than depreciation in home prices, experts are saying that we will probably see a deceleration in price increases. Bottom line, any so-called crash in home prices is highly unlikely. So Steve and I have a suggestion for those of you all who are interested in buying and find the home that you really love. If you find a home like this that works well for your family, consider going ahead and putting in an offer, especially if a home's been sitting on the market for a while. Put in an offer below ask that works within your budget, factoring in the rising mortgage rates. Now, there's sellers out there who are not motivated to sell, and they don't need to sell. So those sellers will probably not entertain an offer like yours. But there are sellers in our market now who need to sell, and they're motivated to sell. Those are the sellers that would consider an offer like yours.
So for demonstration purposes, let's look at some numbers that I think you'll find pretty interesting. So let's assume you're looking hypothetically at $1 million home with 20% down, or $200,000, and you're financing $800,000. So we'll look at the impact of this of rising interest rates. So on an $800,000 loan, we'll use interest rates of 7%. They were a little higher than that last week. I think right now they're a little below that, but for our purposes, let's say they're 7%. So on an $800,000 loan, your monthly note, that's principal and interest, would come to $5,322 a month. If interest rates rose 0.5% to 7.5%, your monthly note would increase $272 a month, or go to $5,594. If you had an interest rate of 8%, your monthly note would increase $548 a month or move to $5,870. Conversely, let's look at the impact that a lower purchase price would have on your monthly note. And for this example, we'll just keep rates steady at 7% so as not to overcomplicate things. So remember, we had this $1 million home with financing $800,000 at 7%. The monthly note is $5,322 a month. If you were able to buy this home at a 5% discount, then you'd have a $950,000 purchase price. You'd be financing $760,000, and your monthly note would decrease $266 a month or move to $5,056. If you purchase this home at 10% under list, well, your purchase price would be $900,000. You'd be financing $720,000, and your monthly note would decrease $532 a month or move to $4,790. And if, heaven forbid, you were able to actually buy this house at a 15% discount to ask, well, your purchase price would be $850,000. You'd be financing $680,000, and your monthly note would decrease by $798 or move to $4,524 a month. So when you look at these numbers, what you'll see is that a 5% decrease in your purchase price is roughly equivalent to a 0.5% move in interest rates. So let's say that you're able to buy a home at a 10% discount to ask. That's essentially equivalent in terms of your monthly note to paying full price for a home, but being able to finance it at 6% rather than 7%. So what Susie and I believe is that if you have a home, you found one that you really like, but it's just outside your budget given these economic conditions, then why not employ this strategy, make it an offer that works with your budget, and who knows, it may just work.
Lastly, remember this. Certain locations establish themselves as destination hotspots. These locations offer attributes which attract investors with lots of buying power. They are not flash-in-the-pan locations. The 30A South Walton area is one of these locations. Steve and I still believe that a real estate investment in our area is a prudent decision and will offer you long-term appreciation on your investment, and in the short term, offer incredible memories and experiences for you and your family. So if you've got any questions or need additional information on any of the information we've covered, well, you know where to find us.